The headline was dramatic: a platform where funds were entrusted for trading and custody, and then a sudden disappearance of access and answers. In this episode, we use Africrypt as a springboard to teach due diligence basics for retail investors. We avoid personalities and stick to practical checks you can run before sending money to any platform. We will explain custody and control, proof of reserves language, payout mechanics, and the signals that separate marketing from verifiable operations. Start with a first principle: who holds the keys? In traditional finance, a licensed custodian holds client assets in segregated accounts with reconciliations and independent audit. In crypto, the phrase, "not your keys, not your coins," captures the same idea. If a platform holds private keys on your behalf, you depend on that platform's controls. Ask whether assets are kept with a named third-party custodian, whether wallets are multi-signature with independent signers, and whether the custodian is regulated in a reputable jurisdiction. If the answer is that custody is internal and proprietary, your risk is higher. Next, clarify control paths. Who can move funds and how are movements authorized? Healthy systems require at least 2 independent approvals for large transfers, with logs, alerts, and cool-down periods that prevent instant drains. Movements to related wallets should be documented and visible to an internal compliance team. If a platform cannot describe its control path in plain language, or if all authority is concentrated in 1 or 2 individuals, treat that as a red flag. Now to proof of reserves. This term is often used loosely. A meaningful proof of reserves exercise pairs on chain balances at named addresses with a simultaneous, independent attestation of client liabilities. In other words, the platform proves the assets exist and proves how much it owes users. At the same moment, with an auditor or a tester you can identify. Screenshots of balances or pie charts in dashboards are not proofs. If a platform advertises proof of reserves, ask for the latest report, the date, the methodology, and the firm that performed it. Check whether customer identities were sampled and liabilities reconciled. If all you can find are marketing blogs, adjust your risk downwards. Payout mechanics are the next critical area. How exactly do withdrawals work? Are there daily limits, queues, or windows? Are withdrawals automatic to external bank accounts or wallets you control, or do they depend on manual review with long delays? A healthy platform encourages small test withdrawals and documents expected timelines. A platform that discourages testing withdrawals or that routes everything through an internal transfer market raises your risk. Remember, fast in and slow out is a classic warning sign. Banking relationships tell a story too. Ask where fiat deposits are held, in whose name, and with which banks. Reputable platforms publish banking partners, at least at a high level, and avoid using personal accounts for client funds. If bank names keep changing, or if the platform asks you to deposit to newly created entities without explanation, pause. Each move may be legitimate, but the pattern matters. Stable, named relationships are safer than a constant shuffle. For platforms that mix trading and custody, understand how your funds are segregated. Does the platform run a proprietary trading book that might use client balances as collateral? Are client assets rehypothecated? What are the margin rules if leverage is offered? If you cannot get clear answers, consider using separate providers, one for custody, one for trading, and your own external wallet for long-term holdings. Complexity concentrates risk when it lives under one brand with unclear boundaries. Documentation is your friend. Read the terms of service before you deposit. Look for sections titled custody, segregation, withdrawals, liability, and dispute resolution. Pay attention to governing law and jurisdiction. If the terms say that assets become unsecured claims in insolvency, treat your deposit like a loan without collateral. If the company is not incorporated where you live, ask yourself how you would enforce a claim. A quick consultation with consumer protection guidance in your country can save years of regret later. Let us separate confirmed and disputed patterns at a high level. Confirmed patterns in platform failures include concentration of control, vague custody arrangements, reliance on internal wallets, and communication that shifts from prompt to sparse after stress events. Disputed matters often include precise balances, timing of transfers, and the role of specific individuals. As listeners, we focus on what you can control: your checks before you deposit, your test withdrawals, and your documentation. Here is a practical pre-deposit checklist. 1. Run a small deposit and a small withdrawal before you commit more. 2. Ask support to name their custodian and banking partners. Note the specificity and the tone. 3. Request the latest audit or attestation that mentions client assets and liabilities together. 4. Verify the company registration, directors, and physical address. Call the published landline. 5. Read recent regulatory news about the platform's name and the principals' names. 6. Set a personal cap. No single platform holds more than a small percentage of your liquid savings. If you have already deposited and you sense trouble, follow a calm sequence. Attempt a small withdrawal to an external account you control. If it fails, try another small amount and document each attempt with timestamps and reference numbers. Contact support in writing. If delays continue, notify your bank or exchange and ask for guidance. Consider filing a report with the relevant financial or consumer authority. Provide facts, not accusations. If communications from the platform become inconsistent, reduce exposure rather than waiting for a large, single payout that may never arrive. Language helps when friends ask whether a platform is safe. You can say, "I don't judge brands, I judge mechanics." For me, safety means named custodians, test withdrawals that clear on time, and proof of reserves that pairs assets and liabilities. If a platform cannot show these, I keep my exposure small or I stay out. This turns the conversation from personalities to practices, which is where your control lives. For builders who want to do things right, publish your mechanics. Name your custodian and auditor. Offer a live status page for deposits and withdrawals. Implement cool-down periods and multi-party approvals for large transfers. Invite an independent firm to attest reserves and liabilities and publish results on a fixed schedule. Provide clear, signed communications when partners change. These steps cost time and money, but they buy trust that survives stress. We close with a steady reminder. The internet will keep producing platforms with strong branding and persuasive language. Some will be honest and competent. Some will be careless. A few will be malicious. Your defense is not perfect foresight, it is process. Ask simple questions. Test your exit. Keep your notes. Diversify across providers and self-custody what you can. If a platform resists basic sunlight, keep your funds in the shade of your own wallet. In our next episode, we widen the lens. We will compile a season-wrap red flag toolkit with the most useful, repeatable rules across scams, corporate failures, and logistics disasters. 10 rules, 1 minute each, that you can share with the people you want to protect. Narration generated with AI, facts verified from public sources. No legal advice is given in this episode. The purpose is education and public safety. If you have a case tip or a documented pattern to share, use a safe channel and remove personal information that could identify non-public individuals.